Moving on to the rest of the globe, as uncertain as the economic conditions are in the U.S. right now, investors are still worried about Europe. They're very concerned about Asia, be it problems in developing markets like India and China, as well as the developed market of Japan after the horrible earthquake. David Katz of Matrix Asset Advisors and Paul Dietrich of Foxhall Capital Management joining me to discuss their outlook for the global markets, not just the U.S. Was wondering, how much of a concern do investors have to have about Europe right now? It's the middle of 2011, and we're still talking about the pigs as if this was, early 2010. Paul.
I think you want to short Europe at the moment. Even if they get out of this current crisis with Greece, it's just a short-term kick the can down the road, because we won't know whether the Greeks actually do all the things that they're promising to do. They haven't in the past. And we're talking about really long-term systemic change over there, and it's going to take a long time, and this is going to be a continuing problem. I wouldn't invest in any banks in Europe at the moment. I think Portugal and Spain are going to have problems, and so we're going to see this as a continuing crisis until these governments actually do what the British government is doing and really bite the bullet and start cutting out a lot of the things that people now feel entitled to.
Right. You mentioned Britain. Obviously, Britain still has the pound, and there's some people who make the compelling argument that maybe the euro was an experiment gone awry, and that we should bring back maybe the drachma and the Deutschmark and the lira from my mother country. Is that viable, or is the euro here to stay, regardless of the problems in Portugal, Ireland, Italy, Spain, and Greece?
We think that the euro is here to stay for now. We don't have a great conviction about the European markets, but we don't think they're going to derail the global markets. We think they ultimately will muddle through this. They'll keep the euro going. And from a U.S. investor perspective, we don't think it derails the global economy. You can invest in the emerging markets if you want into this weakness. And in terms of the U.S., once they muddle through this, we think the U.S. markets start to do better, like last year.
Right. So despite many of the worries about contagion, maybe the contagion is just on the continent of Europe. It doesn't spill over across the pond to the U.S. and some of the emerging markets that do rely on Europe as a customer. China, India, Brazil, a lot of emerging markets have, they had great years in terms of GDP growth. Their stocks have cooled a little bit as interest rates are on the rise. Paul, do you think that there's going to be more tightening from China and India and other emerging markets because of the inflation worries?
Well, that is a big worry. And also, all of these countries are trying to slow down the growth to a more sustainable 6 to 8, 9%, as opposed to unsustainable double-digit growth.
An enviable problem to have.
It is a great problem to have, but it's just as serious for those central bankers over there. And they have been raising interest rates, and when you raise interest rates, it's going to have an effect on the stock market. Most Asian and emerging markets have underperformed the S&P and the Dow over the last year. But the central banks now are basically, especially Singapore, China, are saying their policies are working. They have slowed the economy. That's great for long-term global investors. That's exactly what we want, is sustainable growth.
Japan, clearly an area that, even if you didn't have the awful tragedy that we had in March, Japan's economy wasn't exactly in great shape. Is there a compelling reason to think that maybe Japan can finally grow out of what you want to call it a lost decade, or maybe 2 lost decades at this point, or should people continue to avoid Japan and some of the Japanese stocks there? Paul?
I'd be wary of investing in Japan right now, but they are going to have to do a massive, they're talking about $300 billion to $500 billion in reconstruction and infrastructure work to kind of rebuild after the disaster, and that should be a boost to the economy.
David, I know you invest primarily in stocks headquartered in the U.S., but many of those companies have significant business in Japan. Aflac, obviously, the big insurance company, most notably, has a major presence in Japan. Are you worried at all about any of the companies in your portfolio that have exposure to Japan, or have you made changes as a result of what happened?
We actually look for Japan to be a big plus to the Japanese economy in the back half of the year and to the global economy and the U.S. economy. So if anything, there was going to be a headwind in the second quarter. Most of the companies seem to have gotten through that. biggest effect was on the automobile suppliers, and they're starting to talk about business rebounding at a much quicker than anticipated rate. So we're pretty upbeat about Japan in the back half of the year. We think it's probably a fairly good global market to be investing in. And from a global perspective, we do think it helps the global economy, helps U.S. companies. So if you do have companies that have exposures to Japan, we think that's going to be a net plus as the year goes on.